I'm about to reveal a powerful technique you could apply right now using 3 moving averages, which will allow you to read any market with high accuracy. We'll cover multiple scenarios by analyzing price position and the movement of moving averages. By the end of the video, you'll know exactly what is the state of the general market structure, trend or range, the trend direction, up or down, if there are impulsive moves, if there are corrective moves, if we have dynamic support or resistance, if we have a trend continuation, or if a trend reversal is imminent. You know the drill. Like, subscribe, and stick around for the full video. Let's look at a market which is in a trend. I added 3 moving averages. The length is not important yet. The first one is a 20 EMA, the second one is the 100 EMA, and the third one is the 200 EMA. This is the simplest definition of a trend. For an uptrend, price is above or at the 20 EMA, which is above the 100 EMA and above the 200 EMA. For a downtrend, price is below or at the 20 EMA, which is below the 100 EMA and below the 200 one. For a valid trend, price and the moving averages need to be aligned. If we look at this uptrending market, we observe other key behaviors. Price is pulling away from the moving averages. The short-term moving average, the 20 EMA, moves away from the medium-term one, the 100 EMA. The medium-term moving average has an upward slope, meaning it's not flat. There are no crossovers between the 100 and the 200 exponential moving averages. We also see increasing space between the moving averages. The same for a downtrend. Price is pulling away from the moving averages. The short-term moving average, the 20 EMA, moves away from the medium-term one. The medium-term moving average has a downward slope. It's not flat. There are no crossovers between the 100 and the 200 exponential moving averages. And we also see increasing space between the moving averages. Here's how it looks like when market makes a shallow pullback in an uptrend. Usually, price moves back to the 100 EMA, the medium-term one. Also, price usually bounces at the 20 EMA and 100 EMA, and then the trend resumes. Also, an important note, the space between the 100 and the long-term 200 EMA is not contracting. And here's a shallow pullback in a downtrend. Price moves back to the 100 EMA. Price bounces at the 20 and 100 EMA, and the trend resumes. And the space between the 100 EMA and the long-term 200 EMA is not contracting. Here's how it looks like when market makes a deep retracement in a trend. Price moves back to the long-term moving average, the 200 EMA. Price usually bounces at the 200 EMA and the trend resumes. The medium-term moving average will become flat and will even have an opposite angle, but the slope of the 200 EMA is still trending. And very important, the space between the 100 EMA and the 200 EMA becomes smaller. You'll see a contraction. When the market is overextended, the trend will offer some signals that it might reverse. First one, and the most important one, price is unable to break away from the 20 and the 100 EMAs. You'll see price hanging around this area. Price doesn't have the power to move. Also, price breaks the medium-term 100 EMA in the opposite direction. When you see these two signs, be ready for a possible reversal. Once the price continues to push, a larger reversal might take place. You'll see a break of the long-term 200 EMA in the opposite direction. Or the 100 EMA and the 200 EMA will cross in the opposite direction. As a side note, You don't trade crossovers. You are just observing the evolution of the lines on the chart. We'll talk about this later. When a market is in a range, the angle of most moving averages is flat. Price is moving close to the medium-term moving average, the 100 EMA. This is the favorite location of the price. Medium-term and long-term moving averages are close or on top of each other. You'll also see many crossovers between all three moving averages, between the 20 EMA and the 100 EMA, and the 100 EMA and the 200 one. So let's analyze this chart. First, the trend is up. Price is above the 100 EMA, and the 100 EMA is above the 200 EMA. Here we have a pullback. Price is near the medium-term 100 EMA, and the 100 EMA is above the 200 EMA. Here's a retracement. Price is near the long-term moving average, the 200 EMA, and the 100 EMA is still above the 200 EMA. Here's a reversal. Price breaks the 200 EMA, and the medium-term moving average is crossing the long-term moving average. And here's a range. Price stays around the 100 EMA, and the 100 EMA is crossing the 200 EMA multiple times. For a downtrend, price is below the 100 EMA, and the 100 EMA is below the 200 EMA. Here's a pullback. Price is near the medium-term 100 EMA, and the 100 EMA is below the long-term one. Here we have a retracement. Price is near the long-term moving average, the 200 one, and the 100 EMA is still below the 200 EMA. Here's a reversal. Price is breaking the 200 EMA, and the 100 EMA crossed above the 200 EMA. And here's a range. Price stays around the 100 EMA, and the 100 EMA is crossing the long-term one multiple times. Moving averages also show momentum. First, you analyze price versus the short-term moving average. When price is not hitting the 20 EMA, price has momentum and is showing impulsive price action. Then you look at the price versus the medium-term moving average. If the price is not touching the 100 EMA, again, price is in a strong impulsive price action. The angle of the short-term moving average is also important. A steep angle of the 20 EMA often indicates a strong momentum. You also need to analyze the short-term moving average in relation to the medium-term one. If the 20 EMA is parallel with the 100 one, this indicates strong momentum. And here's a market with downward momentum. The short-term EMA, the 21, is a good indicator to read the market's volatility. If the 20 EMA stays away from the medium-term one, then the market is very impulsive. If the angle of the 20 EMA is steep, then the market is showing strong impulse. And again, if the 20 EMA is parallel with the 100 one, and price is not touching that zone, this indicates strong momentum. Moving averages are offering dynamic areas of support and resistance when very strong momentum is present. Both 20 and the 100 EMA often work as bounce areas when price is showing strong impulse. They also offer dynamic support or resistance when the 20 and the 100 EMA have an angle and are not going sideways. Medium-term moving averages in particular are often bounce zones when the moving averages have a steeper angle. Also, you have another area when price reaches the 200 EMA, which is the last bouncing spot within the current trend direction. The moving averages can also be breakout spots. This happens when price is breaking the medium-term moving average, the 100 EMA. This is the first warning signal. Then, if price is breaking the long-term moving average, this is another indication of a possible reversal. Here's another common pattern. When the price is moving sideways in a correction or range, moving averages will then have a pull effect on price and drag price back to the moving averages. This often creates a false breakout and extends the sideways price action. Price tends to retrace back after a breakout away from the 100 EMA and move back to it, and the long-term 200 EMA also tends to be involved in the middle of the range. Now, I get asked a lot which moving averages are the best. From my experience, most moving averages work well if you use them properly. Whether you choose between a simple, an exponential, or a different type of moving average, it really shouldn't matter much. The difference between a 20 EMA or a 20 simple moving average is very small, and the understanding of the market will roughly be the same. I prefer using exponential moving averages because they place more weight on the most recent candles, as opposed to the simple moving average. I use the 20, 100, and 200 EMA, but you can change the period as you wish. The space between the moving averages will provide information about the trend or lack of it. If there is no space, then price is in a range and not trending. When there's no space, price will have difficulties breaking away. This means that price will often respect the support and resistance levels of the range, and the risk of false breakouts is higher. No space also means that price could also be reversing and moving into a new trend. If the 100 EMA crosses over the 201 relatively quickly, then the price might changing the trend direction. Small space also means that price might be starting a new trend, or a new momentum could start soon. After a period of contraction, an expansion one must follow. When you see increasing space, price is showing strong or increasing momentum. Minor pullbacks are often good continuation trade setups. Big space between the moving averages, but the space is flat or slightly decreasing, means that a correction will follow. In this case, you need to wait for price to finish its consolidation and the correction before continuing with the trend again. Contracting space between moving averages means that price could make a larger and deeper retracement, or it might be ready for a full reversal in the opposite direction. Let's talk about crossovers, let's say between the 20 and the 200 EMA. Ironically, this is often a first strategy that beginners use. But let's be clear, crossovers are not a good strategy for taking entries. When the 20 EMA and the 200 period moving average are at the same price, the trend is not as clear as it should be. What you are really observing at the crossover point is that the average of the last 20 prices is exactly the same as the average of the last 200 prices. If you are looking for trends to trade, this equal relationship of the two EMAs is not a reliable indication of a trend. Here are the two main consequences when the 20 EMA crosses the 200 EMA. Price is either starting a period with a larger consolidation, or price is about to confirm a larger reversal. Now, the moving average analysis is just one piece of the puzzle. These are lagging tools, which means the EMAs will move after the price moves. You will have a delay. But contrary to what is said, many price action traders do utilize moving averages. They don't rely on moving average crossover signals. Instead, their focus is on understanding market structure and price action with the help of moving averages. Moving averages, although lagging, will help you if you know how to use them. If you want a follow-up video in which we'll combine this moving average analysis with price action and market structure, leave us a like and subscribe. And check out our Academy program if you want to further level up your trading. Until next time.